My name is Justin Patrie. I'm a senior director here at Fitch Ratings, and on today's Fixed Interest podcast, we are back talking about commercial real estate. I'm very pleased to be joined by Euan Gatfield. He's a managing director in our structured finance team, and Euan specializes in commercial mortgage-backed securities and is one of our leads on cross-sector coverage for commercial real estate. Most recently, Euan authored a very important report on the contagion risk from CRE valuation declines. So let's kick things off. Euan, where are we in the CRE valuation cycle? Where can we expect valuations to trend over the next couple of years?
Thanks, Justin. And that's a really interesting question. I think, we often talk about the cycle and actually what is it? I think what we saw after the GFC, the global financial crisis, was a good decade and a half of super easy money. And that had the effect of really suppressing the other kind of key drivers of the property cycle. Business cycle and construction activity were kind of in a lull, and in some parts of property globally, notably residential, we really saw the effect of easy money, supercharged markets, and we can all see the effect of that. But other parts of commercial real estate weren't standing still. The pendulum sort of swung from retail property through to industrial property, distribution, warehousing, logistics, driven by a structural factor, in this case, e-commerce. So that was going on sort of separately from anything to do with the cycle. The pandemic has also been a structural shock to property. It's kind of turbocharged e-commerce, and it's also sown the seeds of this current round of disruption in the office sector by seeding a change in working patterns. So those have been going on sort of separately from the cycle, and in many cases kind of overtaken the cycle in terms of the effect on property. Now, I suppose the energy shock could be viewed in the way it saw interest rates kind of revert back to a cyclical trend, sort of a long-term median, as part of the cycle. I mean, that's up for debate, but it does remind us again of how cyclical factors such as interest rates can also, meaningfully bear down on property. And in this case, we've certainly seen a fairly dramatic repricing of lower yielding, in other words, prime commercial real estate globally. So we've seen that correction filter through pretty rapidly in valuations. And I think from here on in, we think structural factors will again take center stage in terms of driving property market conditions. And I think the green transition, it's separate from the pandemic, right? It's a different kind of structural factor, which is going to play out, we think, over the next decade or so, in the drive towards net zero. It's a global phenomenon, and I think on both sides of the Atlantic, we'll see this play out, particularly in Europe, which is a bit more aggressive in policy terms. And what this will lead to is even more polarization, in this case, in the office market, particularly with maybe some secondary assets being stranded or otherwise having to give ground. So that's what we see going forward.
So you've mentioned already, a couple of things, structural, secular changes on top of the kind of the cycle. So how does what's going on now compare to previous CRE downturns?
So for let's say US office, that's in the eye of the storm. And my colleagues in the US, in CMBS particularly, they're expecting an even greater peak to trough, sort of playbook than the global financial crisis, which was obviously very severe. Most of the attention was in residential that time round. Europe saw a lot of fallout from the GFC, but I think that this time round the US looks like it's taken the bigger hit. It's only probably midway through this devaluation. It takes a number of years historically to play out. But even at this stage, we're seeing dramatic declines in value in certain metro areas. I think Chicago, Houston, Denver, San Francisco. These office markets are seeing massive declines in value. The situation for for Europe generally is a bit less severe, and yeah, it's probably a little bit earlier into the process, and probably the process won't be quite as deep for fairly complex reasons. But we still think that the office market is going to see an overall decline, sort of in line with previous downturns. So not out of whack with the early 90s or even the GFC.
So let's move away a bit from office space for just a second here, because commercial real estate includes a lot of other segments like retail, hotel, multifamily. What are we seeing in those segments outside of offices?
Yeah, I mean, I mentioned that the retail has come off, a very serious recalibration, a very serious disruption, which, quite frankly, saw retailers have to take kind of root and branch changes to their business model to cope with e-commerce and to kind of adopt more sort of omni-channel retail offer, and that meant less focus on physical bricks and mortar and a greater emphasis on logistics and distribution, and that's played out to a large extent, I think, now in the UK and in the US, which have been at the vanguard of this transition. And part of that is because even allowing for some loss of overall physical stock in the retail sector, in the retail property sector, mothballing of grade B and C malls in the Rust Belt in the US, or town centers being sort of partly knocked down in the UK where there's been oversupply. Even allowing for that reduction in supply, I think there is an overall excess in supply, certainly relative to what demand there is now, and rents are much more affordable as a result. So that's kind of arrested the sort of self-limiting phenomenon to some extent. And I think retail is probably poised, certainly functional retail is poised to sort of stabilize from here, in our view. And part of that is also because on the logistics side, the e-commerce is becoming more expensive. The pandemic, as I mentioned, it incubated even more sort of home delivery, people being at home more, apart from anything else. And that's kind of hung around. There's also been the, disruption to supply chains, which, recent sort of geopolitics has only emphasized. And I think local logistics capability is it comes at a premium. And the energy shock arguably led to more focus, maybe more in Europe than in the US, where fuel costs have in Europe been spiked more aggressively, have led businesses to economize on transportation and therefore sort of look for more granular logistics networks. So that has supported rents. We've seen an frankly unprecedented surge in asking rents in much of the logistics markets and on both sides of the Atlantic. But I think now the question is, well, as the backlog of leases, come for renewal, will the indicative evidence of releasing spreads, i.e. increases in rents, will that be something that can be extrapolated across the sector? I think there's some doubts we have on that. We're starting to see markets cool off in terms of asking rents. We're starting to see a little bit more vacancy and holding over appear in last mile. And frankly, the macro conditions alongside the nature of these kinds of occupiers does make us question whether really it's going to be possible to increase rents on the scale that some of the sort of asking rent data suggests. So a bit more sort of bearish there, although the fundamentals remain pretty solid. Hotels, yeah, I mean, I think they pretty much bounced back in the US after the pandemic. I mean, it's very hard to generalize, but that appears to be the picture we're getting. And it's almost, you could almost say that period in terms of what was going on, and that was very serious for hotels, arguably the most severely hit part of commercial real estate, given the sort of multitude of negative impacts. It seems to bounce back, and that phase is probably can be erased from the record in a way, in terms of telling us about the future. I think in the US that's more of a strong position to take. In as a domestic market. International travel, particularly business travel, I think we're a bit more bearish about in terms of the overall green agenda and the the sort of remote optionality that is now acceptable in business culture these days in terms of meetings. So I think apart from the key tourist hotspots have bounced back certainly, but I think business travel may be a bit dampened down versus pre-pandemic. Multifamily, as I mentioned earlier, residential generally has had a lot of tailwinds, lack of supply, etc. in aggregate, but there are sort of hotspots of probably oversupply now in parts of the US, notably the Sun Belt, I think triggered by the pandemic and expectations of maybe more permanent reconfiguration of people's living arrangements, and that oversupply I think is forcing some sort of correction there.
If we could maybe just quickly go back to offices, because you mentioned something earlier about some distinctions between U.S. and Europe. So maybe can you just develop that point a little bit on what are some differences that you're seeing in offices between U.S. and Europe?
Well, what the pandemic, the effect in terms of a reappraisal of working patterns and clearly hybrid work has really taken root. That's been a fairly global phenomenon, and that's going to rumble on sort of in most developed office markets for some years. But I do think the US, having taken it faster and deeper so far, I think that there are some sort of historical reasons for that. US cities developed later, a good deal later than their European counterparts, and they developed along different lines with much more proliferation of single occupancy, large floor plate, high-rise towers in sort of dedicated financial districts, sketching out the familiar skyline of silhouetted skyscrapers, but alongside that, sort of more recent growth, there hasn't been that same growth in the provision of public transport. I think that the car has just been a bigger, much more dominant factor in the US than in Europe. And I think that combination does make some of the more sprawling metro areas has made them more vulnerable to office demand hollowing out in the center than in some other locations, importantly in Europe. And we do find cases of, skyscrapers in, Art Deco skyscrapers in the US seeing values tank since origination, in some cases as much as 75%. So there are some really kind of lurid examples of distress that are a bit harder to find in Europe. Having said that, there are some examples. So I don't want to sort of sugarcoat the story in Europe, but the story does seem to be playing out more slowly. As I said, European cities almost universally, those with any scale, have excellent public transport. They are denser typically, they're more mixed use. So I think getting people back into the office has been more voluntary. It's been easier for employers to see numbers start to increase again. Lower rise offices are a bit more flexible for retrofitting, including to sort of the green standards that are increasingly going to be required at the top end of the market. So yeah, there's a bit more support, I think, in Europe as a whole for value. But there are some cities that really did develop more, or areas of cities that developed more closely to the sort of template of the US, with dedicated financial districts kind of carved out from the rest of the city, purpose-built, single occupancy towers, and those kinds of locations are like the Canary Wharf, La Défense. They are seeing some fairly meaningful value declines being picked up.
Yeah. So, final question, of course, since we're a credit ratings agency, is, where are we seeing, some credit and maybe ratings pressure in the various sectors that we cover, stemming from what's happening in commercial real estate?
Yeah, I think the first sort of area to consider would be the banking sector. We obviously were shocked, I guess, and saw some high-profile banking failures not that long ago on the back of CRE to some extent, and so I think there's been a lot of scrutiny in this area, quite rightly, and my colleagues in financial institutions have published a series of reports, kind of exploring this particular angle and how resilient banks are. I think the overall picture seems to be one of maybe above average or above expected resilience, and earnings have been strong. This has allowed provisions to be made. Loan books are reasonably diversified, for the main. And there has been, a bit more credit discipline, I think, in the main, partly thanks to regulations, it should be said, and also, on the liability side, the capital ratios are in better standing than in, let's say, before the GFC. So I think that they come into this with a bit more resilience. There are some banks with much higher concentrations of CRE lending, and including development lending. They do tend to be the smaller banks, the very much smaller banks in the US, and typically too small to really be within the ratings universe, but could still be some source of contagion, I guess, although something that we generally are discounting. I guess any bank has to sort of consider in its loan book, refi risk. And if banks as a whole sort of respond in a very coordinated fashion, or sort of withdraw credit in a concerted way from commercial real estate, then I think refinancing risk is going to increase, and that's something that we'll have to keep an eye on, because in previous cycles there has been a tendency to apply some sort of forbearance by banks when dealing with these kind of loans. That may be a bit less effective as a recovery strategy this time round. I mean, for one thing, interest rates, yes, they're likely to come down, we think, but not to the levels we saw, previously and since the GFC. So it's going to be more carrying cost on those kind of loans, and probably more importantly, the underlying problem on the real estate side in terms of valuation, the impairment to value, that's likely to be less cyclical, less liable to bounce back, more permanent in nature. So time is less of a healer. In Europe, I think one just thing to note, there's a bit less transparency, I think it's fair to say, in terms of valuations, and more lag. So I think we're still sort of monitoring the reporting that comes through, and we'll have to keep a close eye on that. But again, the message does seem to be more sanguine than perhaps some people might have expected on the banking side. The last point, I think we have to come back to CMBS as well. I mean, most of the core CRE exposure in sort of concentrated form that we have in our rated portfolio globally comes in via the US conduit market in CMBS, typically these kind of multi-borrower fixed rate vehicles, lending vehicles, and they do have meaningful office exposure, also retail exposure. I think the retail exposure has been digested from a rating perspective, because that's been a long time coming. The issue on the office side, I guess, is the severity and the recency of this shock. And so loans that maybe made 10 years ago, and they are still finding it difficult to refinance. So that those 10 years have kind of seen a net negative value trend. So we are going to see more loans default. I think that's on the cards in the office sector. Our loss expectations have increased, and this is responsible for some of the downgrades that are filtering through, and the kind of continued negative tone to our rating actions. I think that we'll be expecting for a time, as signaled by the outlooks.
Well, thank you very much, Euan, for sharing all your thoughts on commercial real estate. That's it for this edition of the Fixed Interest Podcast. To learn more about all of Fitch's ratings and our credit views and our tremendous research on commercial real estate, please visit fitchratings.com.